The financial establishment has programmed millions of retail investors to believe that chasing monthly dividend stocks is the safest path to financial independence. Daily, you are bombarded with advertisements showcasing the beauty of passive cash flow, the seductive dream of sitting on a beach while corporate giants quietly deposit cash into your brokerage account. It sounds perfect, and it feels secure. However, when you strip away the marketing narratives and analyze how wealth actually compounds, you discover an uncomfortable truth. Chasing dividend stocks is not a wealth strategy. It is a silent liquidation of capital that dilutes growth and keeps you trapped in a financial slow lane. If you choose to ignore this reality and continue blindly trusting the traditional dividend roadmap, you are voluntarily accepting the absolute cost of your own inaction. You will spend decades watching your portfolio bleed potential growth to unnecessary taxation, corporate mismanagement, and behavioral blind spots, only to realize at retirement that your capital is a mere fraction of what it should have been. The price of ignoring this mathematical reality today is the permanent loss of future sovereignty. If you stay, we will dismantle the dividend illusion, exposing how the elite construct total return engines that compound in silence. To understand why dividends are mathematically ruining your progress, we must first return to the fundamental concept of life energy. Money is not merely paper or digital digits in a bank account. Money is a direct physical representation of your life energy, the finite, non-renewable hours of your existence that you traded to acquire that capital. Therefore, every single dollar you invest represents a piece of your youth, your mental focus, and your biological time. When you deploy that precious life energy into the financial markets, your absolute, non-negotiable objective must be the maximum optimization of its compounding capacity. The ex-dividend math: there is no free money. The foundational myth of dividend investing relies on a complete misunderstanding of corporate accounting and basic arithmetic. The average investor believes a dividend is a bonus. They imagine it as fruit falling from a tree, leaving the tree intact. But a corporation is a closed, mathematically sealed balance sheet. When a company decides to pay a dividend, that cash must physically leave the corporate treasury. It is a direct reduction of the company's book value. Because of this law of accounting, the market must adjust. On the ex-dividend date, the very moment the stock trades without the right to receive the upcoming dividend, the exchange automatically drops the price of the share by the exact amount of the dividend paid. If a stock is trading at $100 and it pays a $2 dividend, the share price instantly drops to $98. You did not create wealth. You did not beat the market. You simply participated in a forced transaction where the system took $2 out of your left pocket, placed it into your right pocket, and called it passive income. You now own a share worth $98 and have $2 of cash sitting in your account. The net value of your wealth remains exactly $100. When that dividend remains in the corporate structure, it compounds tax-free. Forced out of the business, you trigger a taxable event. The government immediately harvests its share, leaving you with a devalued asset and a diminished cash position. The silent tax leak of passive income streams. To build an unbreakable financial fortress, you must become a clinical operator obsessed with minimizing structural friction. In the arena of wealth compounding, there is no greater, more destructive friction than unnecessary taxation. This is the silent tax leak that dividend investors completely ignore in quest for passive cash flow. When you invest in a compounding company with no dividend, capital grows in silence. If the stock doubles, you owe nothing. Earnings are reinvested inside a tax-sheltered vault. You only pay taxes when you decide to sell, maintaining control. But the moment you shift your strategy to dividend-paying stocks, you surrender that control. You are handing the keys of your tax schedule to a board of directors. Every time a corporation issues a dividend, they are forcing you to realize income, regardless of whether you need the cash, whether the market is crashing, or what tax bracket you currently occupy. Even if you have set your account to automatically reinvest your dividends back into the stock, the IRS does not care. They tax the dividend income the year it is received. This means you are paying taxes on money you never actually spent, using cash that should have been compounding to fund a liability created by a forced liquidation. Over a 30-year horizon, this constant, annual leakage of capital to taxes completely destroys the exponential curve of your wealth. A dollar tax today is not just a dollar lost. It is the loss of all the future compounding generations of that dollar. You are physically cutting the wings off your compounding engine before it has the chance to reach escape velocity. Behavioral blind spots, chasing yield versus buying equity. The stock market is an incredibly volatile, chaotic environment where your hard-earned capital can fluctuate by 30% in a matter of weeks, triggering a primal fight-or-flight response in your brain. When the market is crashing and your portfolio is deep in the red, looking at declining values creates genuine physical anxiety. This is where the psychological drug of the dividend trap offers temporary relief. When an investor receives a dividend check during a market downturn, their brain interprets that payout as a sign of safety and control. They tell themselves that the stock price is down, but at least they are still getting paid. It is a beautiful, seductive story that completely pacifies their anxiety, but this comfort comes at an astronomical cost. By focusing on the cash payout, the dividend investor separates the dividend from the share price, failing to realize that the dividend they just received is the exact reason their share price fell on the ex-dividend date. They are treating a forced amputation of their own capital as a life-giving transfusion. Furthermore, this obsession with yield forces investors to systematically misallocate their capital. They reject high-growth, innovative companies that reinvest 100% of their earnings back into dominant projects, choosing mature, stagnant industries that pay out cash because they lack innovative ideas. If a company is paying an excessively high dividend, it is often a silent admission from management that they do not know how to generate a high return on capital inside the business. They return the cash to you because they have reached an end. Consider the contrasting lives of Ronald Read and Richard Fuscon. Ronald Read was a simple gas station attendant and J.C. Penney janitor who quietly saved what little he could and invested exclusively in high-quality blue-chip stocks over decades. He had no academic pedigree, yet through extreme patience and compounding, he died with a fortune of over $8 million. How the elite structure asymmetric total return. To break free from this retail trap and join the top 1% of wealth builders, you must elevate your financial consciousness. You must stop thinking like a consumer who collects coupons and start acting like a sovereign architect of capital. Investor Naval Ravikant identifies that true, generational wealth is built on two specific pillars: judgment and ownership, also known as equity. You do not build wealth by renting your time, and you certainly do not build it by collecting retail dividend payouts. You build it by acquiring equity in highly scalable asymmetric systems. When you invest with a total return mindset, you focus entirely on the growth of the underlying asset. You want the business to retain its earnings and deploy them into projects that generate compounding value. If a company can reinvest its profits at 15% return inside the business, letting them do so is infinitely superior to forcing them to pay you a dividend that you will immediately tax and reinvest at a lower rate. Look at the legendary compounding engine of Berkshire Hathaway. Under the leadership of Warren Buffett, the company has famously refused to pay a dividend for decades. Buffett understood that every dollar kept inside Berkshire could be compounded at a far higher rate than what individual retail shareholders could achieve. By keeping cash inside the system, Berkshire bypassed the massive tax drag of the dividend mechanism, allowing the portfolio to compound exponentially into a trillion-dollar empire. If you need cash to fund your lifestyle, you do not need to rely on a board of directors to force a liquidation. You can create your own homemade dividend by simply selling a small, precise percentage of your shares when you need capital. This approach is mathematically identical to receiving a dividend, but structurally superior in every way. It allows you to maintain absolute control over your tax schedule, deciding exactly when to trigger capital gains, how to offset them with losses, and keeping the rest of your portfolio compounding in total, tax-free silence, reclaiming your sovereign compound engine. Escaping the dividend trap requires a brutal, clinical audit of your financial behavior. You must recognize that the desire for predictable monthly cash flow is often an emotional coping mechanism driven by the fear of market volatility and the need for immediate gratification. True wealth is not measured by the number of dividend checks you collect. It is measured by the absolute, unyielding control you possess over your own time. As Housel observes, the highest dividend that money can possibly pay is the ability to wake up every morning and say, "I can do whatever I want today." True wealth is having the sovereign power to walk away from a toxic environment, to ignore an obsolete corporate hierarchy, and to completely insulate your family from economic chaos. When you allow the allure of monthly yield to dictate your investment strategy, You are prioritizing the synthetic comfort of regular payouts over the absolute efficiency of your compounding machine. You are allowing corporate boards and tax codes to dictate the velocity of your wealth. To achieve true financial sovereignty, you must suppress your ego. As Morgan Housel notes, saving money is simply the difference between your ego and your income. If you can live comfortably below your means, ignoring the social pressure to display your wealth through consumer goods, you build a massive margin of safety. You free up capital to feed your tax-efficient compounding engine, allowing your assets to grow in absolute silence. Furthermore, you must prepare for the psychological reactance that occurs when you lose control over your time. As Jonah Berger explains, humans have a deep biological need for autonomy. Doing work you love on someone else's schedule or being forced to manage your portfolio based on immediate cash needs eventually feels identical to slavery. True independence means decoupling your income from your physical presence. Stop funding the retail dividend illusion. Starve your ego. Build your total return compounding engine in total silence. Let your capital compound without the friction of annual taxation and become the sole, sovereign architect of your time. Hit the subscribe button to break the cycle. But before you go, let's open the debate. Be brutally honest with yourself. Are you chasing dividend stocks because the math works for your portfolio? Or are you just paying a massive compliance tax to get a predictable hit of psychological comfort during drops? Defend your reality in the comments below. Master your mind. Build your system. See you in the next protocol.